Hello and welcome to another session of Market Roundup for Sunday, March the 23rd. This is George from TRADEPRO Academy. Boy, did we have a rocky trading market in the past week. A lot of developments, a lot of things came out of the woodwork. And of those, the one that had the most paramount importance was the chairwoman's, Janet Yellen's, press conference on Wednesday at 2 p.m. All right? Why was this such a huge debate? Why was it such a huge subject? Well, she came out to give a pretty standard speech that was pre-written that would say, we're going to cut down the stimulus program another 10 billion to 55, and we're going to hold rates for longer periods or as long as needed to accommodate some of the quantitative easing we are doing. All right, and the terminology used was considerable time, and that was all in well. But then came the question period, and they asked Janet Yellen. They said, well, how long is this period that you're saying considerable time? And she said, you know what, it's hard to define, and that's where she should have stopped, but said, but it's probably something in the order of around 6 months. All right, and that was huge. That was a shock to market participants because the predecessor of Janet Yellen, who was Ben Bernanke, who's no longer in the position, would always say, well, that depends. We're going to monitor things closely. We're going to see how it goes, and we'll only take a decision if it's right for the market. And the markets like that kind of long-term, grander scope without any definition, without any deadlines. Janet Yellen did not do that. What she in fact said was targeting a date of spring of 2015, if you take into context a wind down of $10 billion a month plus another 6 months or so. All right, so she defined a deadline for this stimulus program when the Fed will completely exit and allow interest rates to go back up. All right. That's an important time. If that was to happen, it would put a considerable amount of stress on the markets. And if the economy is not recovering, which, spoiler alert, it is not recovering the way that was anticipated because of the labor market, well, then things could come to the downside. They can drop. It could get really hectic and volatile. Speaking of hectic and volatile, that's exactly the two words we would use to sum up the following price action of the week. Look at this. It started here Monday, Tuesday, Wednesday, Thursday, Friday. We had one up day, and then the week went completely sideways. All right, on the comments from Janet Yellen, the market first dropped. It then rallied to almost a new all-time high and then closed down once again. So extreme volatility. But what's the one thing that catches our attention here is this, isn't it? Look at this volume. This is huge selling volume. A day like this where the price does not move much and in fact closed slightly bearish and we have high selling volume. Guys, this is bearish as it gets. All right, we can expect some downside movement to happen as market participants divulge this news, and we now find ourselves in a bit of a triangle situation, which could be viewed as a pennant. So there's two ways to go in a pennant. If it breaks to the upside, well, we have a little bit more bullishness left. If it breaks to the downside, we're going bearish to probably that 1774 level, maybe even this low, and then we can go sideways in the market for a couple of months. All right, everyone thinks it's either going to take off to the moon or it's going to drop like a stone. Well, there's always a third alternative, isn't there? That third alternative is doing this for a couple months between 1880 and 1750. If that was to happen, then oh boy, we're going to be happy. There's going to be a lot of money to extract from the markets in a range-bound scenario. Okay, so there you have it. That's what we're looking at. Just draw these lines for yourself. That looks somewhat like this, and if it breaks down, well, downwards we go. If it breaks up, how much space do we really have? Well, I'm going to show you. We have a little bit of space here, so from the 1885 level or so to about, if it takes the same course or the same angle of ascent, we have about 1940. Okay, guys, so really less than 100 points or so of upside. And why do we say that? What's this blue line represent over here? That's a very interesting question. Let me show you the answer. If we go on the weekly chart and we zoom out, look at this trend channel that we're currently in. This started at the bottom of 2009, the financial crisis, the panic, the sell-off. This was the low that was established. It then rallied for a retracement, and then the trend continued. So we hit the support 1, 2, 3, 4, 5 times, resistance 1, 2, and now we're going for a third hit. All right, now we're not necessarily saying the second it touches it's going to drop, but it has before once, it has done it twice, and so it's in the confinements of this trend channel, and that's really the possibility and the likelihood. It doesn't have to happen, but there's a great chance that it will. Right now, this is not a level that you should be buying any kind of equity. All right, this is the level that if you had bought earlier when we had suggested, now you'd be selling. Okay, guys? So it's certainly not a buyer zone. And if you're not buying, if all the smart money's not buying, then here's the question. Who is? Who is buying, and do they have the money to continue or sustain this trend? Because if everyone's bought all the money that they've had, if they spent all their money to buy stock, there is no more money left to purchase additional stock, and there's nobody left to push the market up. Is this the case? Well, let's have a look. Every day we have rallies, volume's dropping off. That means we're increasing, we're still going up, but on less volume. This is showing us that people are running out of money. Okay, on this rally, look, volumes are low, and they even start dropping off. And then we get one down day, and the sellers come out of the woodwork. This is a very interesting development and shift in terms of psychology in the markets. All right, looking at the moving averages, while the 10 and 20 day are acting as support at the moment, they're going to give us some really support to the upside, but they can be broken easily. What they've done is they've converged and went to a relatively neutral scenario. Holding above this 50 is what we're looking for at 1832. Okay, we have to hold this level. If this level breaks, all the algorithms, people, traders, investors, money managers, hedge funds will see the same thing, press the sell button, and it'll take us relatively quickly down to 1750. Okay, long-term moving averages. Well, long terms, we broke the 100 here. We broke it here as well, so you could see it reacts to it. Just takes some time, and now this 100-day moving average is around 1825 or so. So for us to break, expect to find some support here, at least in the near term. And I mean, at any given moment, support can break. So it can do this, yes, it can, but it might do it more in this kind of fashion, an ABC retracement, or sorry, a role reversal rather. The breakout, retest, and then continuation downwards. That's the likely scenario in the bearish scenario. So if it breaks bullish, well, obviously we could ignore that. Okay, let's look at the momentum. One of the key pieces here is that even though the market's holding this high, look what's happened to the momentum, guys. It's crossed, it's turned, and it's in fact bearish. All three stochastics, bearish. Okay, check. RSI, bearish, check. MACD, bearish, check. They've all crossed, they've all turned, they're all signaling negative momentum here. So the power is with the sellers. The volume is high, the momentum is negative as denoted by our three measurements here, stochastics, RSI, MACD. And now the price just needs to come in. If we have a bearish day tomorrow, then oh boy, downwards we go. Okay, looking at the Bollinger Bands, interestingly enough, the only way we use them is to see a zone where there might be a pinch, and we're getting into that zone right now. The bottom band is headed upwards, top band is stagnant or the same, so if they're converging and continue to converge, this scenario would look kind of like this scenario right here. Okay, well, that was a pretty bad way to draw it. Right there. All right, look how tight these bands got. What happened after that? Bam, it broke open and the price moved downward. So that's what we're looking at here with these bands converging. Has the same implications on the trend for the equity markets overall. Okay, guys, that's really the overall S&P 500. Looking at the Dow Jones, we've talked about this. The one thing that worries us is while the S&P 500 is hovering near the all-time highs, what is the Dow Jones doing? It's doing lower highs. All right, and that's really a characteristic known of the bears and not the bulls. So that's something as an area of concern. One of the things that's good for the bulls or for the people that believe the stocks can go up is that that the lows are actually higher. Okay, and that's why we got some triangular formation here of a consolidation going on in the Dow. But look at this. So here's the Dow. Now look at the S&P 500. Looks much more bullish in terms of prices are hovering near the all-time highs, whereas the Dow Jones looks like it's actually breaking down. Okay, and it looks like it's going to go bearish. And look at this massive, huge selling volume on the Friday. Jeez, I don't know what happened there, but just a whole bunch of people decided it was time to dump it. Okay, Nasdaq, or the CompQ, huge bearish engulfing there. Huge, massive on huge bearish volume. There's going to be some downside problems coming up this week. It almost looks certain and very likely this could take place, right? Usually we do one stock pick or one trade for every week. The one we're going to look at this week is Starbucks. It presented fantastic opportunity on the breakout here. We talked about it in our market analysis live sessions on high volume. Now it looks like it's going to retrace. So for those of you that didn't get a chance to jump in, hold tight. We'll give you a better opportunity to jump into this one. So follow us on Twitter for that information. We keep updating stocks All right, our account is at TradePro Academy. That's our Twitter handle. Join the discussion there. We'd love to hear from you. Also, sign up on our website at tradeproacademy.com and you will get 30-day free access. That's actually 4 webinars on every Sunday, 90 minutes long. We analyze 12 stocks, 4 indices, and we make sure we set up some trade plans that are highly precise, highly accurate, and very profitable. So far, we've generated an over 80% return on an annualized basis. All right, guys, you're doing a fantastic job. We'd love to have you join us for the webinars. And last but not least, we also have the Foundations course starting in the month of April. In just about 10 days or so, we're going to get started there. It's a 36-hour, 24 live webinar course that teaches you the foundations rather of technical analysis, how to use it, how to apply it, and how to make money trading the charts. You guys, you have yourself a fantastic trading week. Good luck in the sessions to come, and we'll touch base with you next week on Market Roundup. Take care, everyone, and have a fantastic day. We'll talk to you soon. Goodbye.